Hello, today I am going to talk about latest quarterly financial performance of Ashok Leyland, which is the second largest commercial vehicle manufacturers in India. The company posted an inline set of numbers, especially in the environment which is very weak and gloomy for the commercial vehicle segment. Let us discuss the key highlights from result. The company posted a decline of around 12% in its net revenue, driven by decline of 6% in its volume and the similar decline in its realization. Volume witnessed a decline primarily because of 16.6% decline in M&H CV segment, whereas LCV segment witnessed a growth of around more than 25%. Realization, however, continued to witness weakness primarily due to the competitive weakness and the weaker product mix. Moving on to the operating profitability, despite a significant rise in raw material prices and competitive intensity, the company has been able to maintain its EBITDA margin above 10%. However, it contracted by more than 140 basis points in this quarter as compared to the last quarter. The company, however, and the management, however, is very confident of its EBITDA margin above 10%. Now, moving on to the stock outlook, there are a couple of factors that we need to look out for. First is the domestic industry outlook. Automobile industry, especially the commercial vehicle segment, has been reeling under multiple blows, primarily due to many macroeconomic challenges led by increase in the interest rate, liquidity crunch, change in the Excel norm, and the Ashok Leyland, being a second largest player in commercial vehicle segment, is not an exception and has been impacted negatively due to this. However, the short-term outlook remains sluggish, but the long-term outlook remains very positive, primarily because of the government's focus towards infrastructure activities, construction and mining activities, and lower penetration. Moving on to the export outlook, the export economies such as Sri Lanka and Africa have been facing multiple challenges, primarily because of political uncertainty and volatility in stock prices respectively. Bangladesh, on the other hand, continues to be very positive. The management indicates that these are the key growth drivers for the company going forward, and they have started focusing on most of the vehicles to be left-hand driven vehicles, and they continue to have a very aggressive plan to capture the export market. And finally, the attractive valuations. Amid the weak demand outlook and stock market volatility, stock has corrected quite significantly, making the valuations very attractive. The company currently trades at around 11 times FY20 projected earnings, which we believe are very attractive and reasonable for long-term investors. Overall, Ashok Leyland is a sweet spot to take the advantage of commercial vehicle growth coming in India. That's it from my side. For more news and update, please log on to moneycontrol.com.